Hello there. Welcome back to the Everyday Growth Advisors podcast series, the Growth Series number 2. And today we have another guest with us. As you know him, a famous member of our OptionsSwing platform, MikeMas, who is one of our most legendary traders. He has been a professional trader for a very long time and has considerable experience with market strategies and also market finance with psychology as a major factor. Today's podcast brings us to a couple of important things that we're going to discuss. Some of the topics are going to include the Fed's decision, animal spirits, some behavioral finance. We're going to talk about how tax obligations can be viewed from different angles, and also how you should maybe perhaps allocate different strategies for different conditions. We hope that you sincerely enjoy this, and so I would like to formally welcome Mike back. How are you doing, Mike?
Doing great, man. It's nighttime here, just winding down. Had a very eventful market day and just day in general. So always thinking about these topics, though. So I'm glad we're having a chance to have a debriefing here.
Absolutely, man. Did you grab your whiskey? Are you ready, man?
Yeah, had a little shot after dinner, and just kind of sipping on a little water right now, and just ready to kind of dive in and have a good time.
Awesome, dude. Yeah, this is what it's about, having a good time. So first thing, as a hot topic, right? We had the Fed make a decision yesterday about monetary policy, and obviously no surprise there. We weren't expecting them to make a change.
Yeah.
But definitely want to hear your thoughts here.
Yeah, it's the printer's still going to run. As you mentioned, they're not going to change the rates. I watched some of his comments, and I'm a little worried about this stance about how printing all this money is not going to cause some inflationary problems, because basically what we're doing right now is heavily devaluing the dollar. And
Absolutely.
what does that really mean in the long term? You're going to see certain asset classes bubble maybe more so than they already are. You're probably going to get to a point where just everyday cost of living for a majority of people in this country is going to be really difficult, because I think that sometimes they measure inflationary things on hey, well, oil's all right, or this is okay, so spending overall is good. But then you go to the grocery store and all your food is 50% higher, so and wages aren't increasing and things like that. So there's a lot of factors going on right now. I think that with the COVID situation, if you look at this from a business standpoint, a lot of businesses have gotten some reprieve temporarily, but that just kind of delays the inevitable. So what's going to happen with the customers that aren't coming back right away, or what's going to happen when you've had to cut 70% of your workforce, and now you need to hire people again, and either they're not available, or hey, if they're getting checks from the government, they're really going to want to go back to work. So really interesting stuff going on in the economy that you can see. I think that the next couple months is really going to be eye-opening.
Yeah, I agree with you. And I think just parlaying off what you said with the unemployment and then re-employment, many people don't realize, and I'm obviously not saying this because I'm a bear or anything like that, but we are obviously heading towards a point where we need to start being cautious. But many people don't realize that when the market goes through this kind of a whipsaw, there is two things that happens. There is a frictional unemployment, and then also there is structural unemployment, which means that there are a lot of job classes that are going to be reclassified. So people who were previously doing certain things are going to move to other sectors of the job market, and at the same time, those people need retraining and they need reassessment, and so those things cost money, right? It all costs money.
Absolutely.
And so, I don't, as I completely agree with you. There's a certain, level of confidence that the Fed can keep throwing at the market, but then one day somebody's going to call bullshit, and it's beautiful that you brought it up right before we got into the podcast. This is definitely, and I know you've been talking about this for a while. This is definitely what has happened in the previous times in the 2000 .com bubble. In fact, this period,
Yeah.
which was coined by Alan Greenspan as the irrational exuberance period, is a perfect way to describe the scenario right now, right? We have an economy
Oh,
that's faltering and teetering on its tails, and yet the stock market is at constantly making all-time highs. And it's great, but it's not that great. So
yeah, exactly. I agree with you. And I actually, that's about the first time I started understanding the stock market was around the 2000 bubble. I was in college at the time, and I was a computer engineering major. So for me, all the boom and the .com and the internet and everything it was very exciting, to the point that as you mentioned, irrational exuberance. I mean, that's really the direction it headed. Everybody was like, oh man, I got to jump on this. I mean, major FOMO,
yeah,
major, just everyone was a stock expert. Everybody was like, oh man, you got to buy into this. And, next thing you know, you've got pets.com coming out that has 5 employees, people sitting in a garage, and they just bought a domain name, and then all of a sudden they're worth billions of dollars. I mean,
for reals, yeah.
yeah. And you're starting to see a lot of this, unfortunately, in this market. I mean, you've got companies that may not have any deliverable product. Their entire company worth is based on an idea or some excitement. Even some things that are just blowing my mind. Companies are declaring bankruptcy, and their stock is being bought up by a bunch of novice investors, thinking that I'm sure they're going to get bailed out by the government, without really understanding how all the fundamentals and things work. So I think that there's going to be some sort of a rug pull. What that really looks like, we don't know at this point. Like I said, it's probably going to be a couple months before we really start to see what are the effects of this policy that we're doing. What are the effects of this post-COVID world that we're coming into? But I can tell you that a lot of the speculation and the YOLOing is some of that's going to have a hard slap to the face for sure.
Yeah, absolutely. And I see this market continue to melt up. Honestly, I think that we can go higher. But then at some point of time, as you said, the rug pull is going to be inevitable, and it's going to be epic. Like, people are going to be left holding the bag. And I cannot stress it that you have to start seeing this from now, right? You start recognizing the problem, and you build a case study. Like, that's my approach anyway. I'm a very case study based person. So I always try to build a case study. So, okay, if you understand what the market is, what is happening to the market, and you realize that, asset prices are starting to bubble up, it's coming to a phase where things are getting overvalued, like how the NASDAQ has reached all-time highs and surpassed it. Whereas, S&P 500 and Dow Jones remain laggards. And, you can see that there's a clear disconnect, because tech is clearly the modus operandi of investors right now. They're saying everybody coming to the market, especially as a new investor, is like, okay, well, I'll just buy options on a bunch of tech, and I'm just going to make a killing. But they don't realize that this is not sustainable in the long run, because you could keep doing that. One day you're going to lose everything, right? So
yeah, especially if you just kind of you have the mentality. And that's why I'm glad we're going to be discussing the topic of market psychology and kind of the way like bulls and bears think, because basically it's easy to get wrapped up into that the market's only going to go in one direction, how could this not work? And then you got guys like Dave Portnoy, the Barstool guy, just saying, this is so fucking easy, anybody can do this. And everybody's watching this thinking that, oh yeah, man, it's I put money in the market and I get 10 times back out. Like it's win-win, but nobody understands even what they're trading. Like yeah, I'm trading options. And you can just ask, well, how does an option work? Well, I just kind of buy it. And if I buy a call and it goes up, I make money. If I buy a put and it goes down, I lose money, or I make money. If it goes down, I have a put, and then they kind of have this casino mentality.
Yep.
So to me, I kind of look at the market, again, when I think about the dot-com bubble, it was a casino mentality, and I'm seeing the same casino mentality now. Everybody wants to get in it. They're putting in, people are putting stimulus checks into the market. I think I saw an article of some girl doing that. So that's really feeding in again to this irrational exuberance that we're seeing now.
Yep.
And it's mind blowing. And unfortunately, I think now with the advent of social media, all the access to information we have, it's very easy to get pulled in one direction. It's very easy to get, false information too. So it's kind of a double-edged sword right now. But that's why you really need to understand what you're doing, what you're trading. What is this option? How does it operate? Why are the premiums going up or going down? Why does it work this way? Because if you're just go to the casino in that case. You know what I mean?
Yeah,
just go to the roulette table. It's not much different. But once you understand the fundamentals, you can really kind of adjust your strategies and things like that to capitalize on the things that have the lowest amount of risk. And again, that's what I preach to everybody is risk management and capital preservation should be your two most important things that you think about before ever thinking about profits or charts or anything like that.
This is why me and you align, man. I'm telling you, you're exactly like the sun and I'm the moon, man. I just reflect the light off you because honestly, that's exactly what I think, the exact same way. And that's what I keep preaching. And, I think this is the reason why we have a great synergy when we do these podcasts, because this is exactly what I say from the beginning. It's like, if you don't understand what risk management is, how are you going to remain profitable for a long time? You could put $1,000 down and turn it into 10,000. You'll look like a hero for a week. But then guess what? At the end of the year, I probably won't see you in the OptionsSwing chat. You're probably going to be gone. And, that's not a trader. That's a
exactly.
Gambler.
Yep.
So,
That's the game. Exactly. Yeah. I think that there's a really good movie. It's an old movie with Matt Damon called Rounders, and it's about Texas.
I remember that.
Yeah, it's about Texas Hold'em poker. But one of the intriguing things that I learned from that movie was it's John Turturro's character that's kind of telling him that, hey, you know what, you can get on me about the quote unquote grind, because I'm going every day and I'm working my strategy and I'm getting money every day. But in the long run, that's why he doesn't have the ups and downs, and that's why he keeps his lifestyle, and he has he has winnings all the time, and he has consistency, is because absolutely, he has a strategy and implements it, and it's not going and, hey man, I'll put it all here and I hope I win. That's a recipe for a lot of emotional turmoil and financial turmoil too.
Yep. So I wanted to get your idea on a couple of things. So first things first, with the Fed's decision, I realized one thing. Obviously, there is a big difference also with the Fed now and the Fed during the dot-com bubble. I just want to wrap this topic up so that we can actually move into animal spirits and the behavioral finance part of things, because I know, we want to concentrate a big part of this podcast on that. And our viewers are going to be very, very thankful. I can definitely assure for your wisdom on this, because I'm sure that you have a lot to contribute. So one of the major things that I realized was during the dot-com bubble, we had Alan Greenspan, who was a relatively more hawkish Fed. And, he was the person to actually step in and say, hey guys, look, you guys are going crazy with this. And, we are in a phase where asset prices are completely inflated. We need to have a reality check. And he was actually the one to put in a tightened monetary policy that caused the wave that set off the dot-com bubble, right? And I don't see the same thing right now. So there is a difference between the Fed back then and the Fed now. I've said this so many times on the live stream, and I've talked about it in the articles that I post on Everyday Growth. You know, a difference in the Fed nature causes a big market sentiment shift. You know, so if people are very dovish and they think, oh, the Fed's just going to keep, you know, giving us unlimited money, then this market's going to continue to go out of control. And institutions, they are happy to put fuel on the fire. They want prices to expand because, you know, they know when to get in and out. They have all kinds of information that they use, which retail traders don't have access to, right? Even as we were talking about it earlier, there are so many tools that people use nowadays, but it's definitely not sufficient for retail traders to understand the cadence of the market. Many people still get misled because they don't understand when institutional money is flowing in and out. And because of that, they get caught holding the bag more often than not. So this is the major difference that I would like to highlight to everybody. We now have a overly dovish Fed versus the dot-com bubble where we had a hawkish Fed. And that does a lot of different things for asset classes. It creates a situation where people are more willing to dump money in than to hold back. And I think that you have to be cautious in an environment like this because even though we can melt up further, we can easily take the elevator down and it can come down fast.
Yeah, absolutely. You know, it's the election year and you know, having a president that is very business minded and puts pressure on the Fed from that standpoint too. Definitely has I think that's kind of a big thing that we're starting to see. I think that you know, the Fed chairman, I think Greenspan at that time, you know, had more of a backbone and was more able to see the bigger picture and just get things under control. Whereas now it's just, you know, thinking about the now, you know, think about it. I mean, honestly, the economy is the focal point of the presidency now. And I think that the stock market is the biggest indicator of that, even though the economic fundamentals right now aren't very good to support where stock prices are right now. But it's really important for that perception to be there. And I think that from my standpoint, in my opinion, I think that's really feeding into what we're seeing now. And I think that, you know, when we have a Fed chairman that's willing to kind of stand up against that and make sure that, hey, you know, we're not kicking the can down the road and ruining things for future generations. I think that's really important, and I'm just not seeing that right now.
Absolutely, I agree with you. And you know, there's obviously a couple of reasons why the Fed has chosen to, you know, hold rates steady, and they said they're going to hold rates until 2022 at least. You know, a weak dollar, it can cause a lot of impact on the economy, but then majority of the impact, you know, usually means that, you know, other currencies are going to be stronger against the dollar. It actually particularly improves conditions with trade majority of the time. And since, you know, we are already having some, you know, geopolitical tensions around the world, a weak dollar might actually allow the U.S. to recover. But then, as we have said, this is going to cause problems as well. So with a weak dollar, it usually makes things on the trade front a little better because, you know, people are more willing to do trade with the U.S. since the dollar is cheaper. They're able to purchase at a cheaper price. But then it also creates a asset inflation bubble where, you know, things are also valued differently. I do see that, you know, the market's going to continually kind of inch higher and higher to the point where, you know, we will have a kind of a realization moment, like an aha moment. And you can see it happening now. Retail traders are starting to only realize right now that it's time to invest. And the actually that wave is already missed if you think about it, right? The retracement from our lows, that was the time you buy, right? And now people are going to greedy. Like as Papa Buffett always says, right? You got to be fearful when people are greedy and greedy when people are fearful. So right now is that moment where we're seeing us enter that moment where people are getting greedy. And so this is going to be continuing for a while. I project it to go at least for maybe till the end of the month. And then the end of June, we should see some kind of a pullback because that's how the market works, right? The cadence. We'll see a couple of
Yeah.
corrections here and there, but nothing crazy, right?
Yeah. I kind of, in my mind, I kind of look at market sentiment like a pendulum. So if you're kind of thinking about the pendulum and it swings too far one way, well, it's going to start going back the other way too, because it just can't keep going in that direction. So, that's honestly what was funny is that when we were getting around the 225 mark and the SPY, I remember telling a few people, I'm like, man, I feel the bottom is in. Yeah. Just because everyone is like, oh man, SPY's going to zero, like everything's done, and I'm like, yeah, when everybody's kind of having that, I'm kind of thinking like, all right, I think this might be the turnaround. And now that we've kind of made this complete V-shaped recovery, everybody's an expert. Again, the things I saw in 2000, everyone's a stock expert. Everybody's talking about, oh, you need to buy this stock. People are investing in stocks they should not at all invest in because of fundamentals. Yep. These are all the signs that it's just kind of like, all right, yeah, I need to start observing. And like you said, I think that, our economic policies, I think you hit it on the head. It's actually going to continue to cause this asset to bubble. It's just, why is that? Well, the reason is because where else are you going to put all this money they're printing? You can't put it in the treasuries or bonds or anything. Where's the return? And you and I were talking earlier, and you made a good point that the S&P dividend is actually higher than any return rate that you're going to get anyway. Yeah. So that's why all the money's flowing there. Unfortunately, what's really happening overall through this policy, though, is kind of a wealth transfer. So,
oh yeah, absolutely, agreed.
Yeah, that's the scary part overall, because how has this really helped 300 million Americans?
No, it doesn't.
It really hasn't.
It really helps the rich people.
Yeah. And overall, that's, I think the cherry on the top with the conversation we're having with the Fed is just that, is if you look at this from a really high level view and what this really is, it's really turning out to be just a big wealth transfer.
Absolutely. Great, man. I really, really like what we're discussing so far, and I love the direction we're going. I would just like to end this note to say that, it's probably one of the most exuberant times that we live in right now. And I want to get ahead and, say that this is just the beginning, because I think that we're going to, just like how you view the market as a pendulum, I sometimes view it as like a rubber band, right? Where it stretches and stretches and stretches and stretches, and then boom, one day it snaps. And then again, it stretches and stretches and stretches. So it keeps stretching in either ways. And I think this may be a good segment for us to kind of move into animal spirits here, because this is exactly how the bulls and the bears differ, and this is exactly what happens in the market. So I want to start off by kind of getting your view on what is the characteristics of a bull, and what are the characteristics of a bear in your perspective? How do you see them?
Yeah, I think overall this really kind of gets down to the market psychology, or the psychology you need to have. You need to realize that when you get into trading, it's not just about going and making money. You need to realize how you react to that, because so many people have emotional reactions to both losing money and also making money. So you have your greed and your fear, and that's your bull and bear case. Yep. So so when you're looking at it from that perspective, it's really important to know how to control these emotions, and how to really analyze the sentiment that people have from that, and the sentiment that you will actually have from your own trading too. one of the things that, that, I mean, I'm very big on when people start trading is to do the paper trading.
Yeah.
You know what I mean? So what is the paper trading will teach you, your fundamentals. You can go in and you can learn the charts. You can do this and that. The one thing you're going to miss out on is this emotional aspect, is this, how you react to, the greed and the fear. So one of the things that, if you're an optimistic bull, you just, you're constantly chasing the momentum. You're optimistic. And because of that optimism, you sometimes just that you don't have enough fear. Does that make sense?
Yep, absolutely.
Yeah,
There.
because you're not kind of checking yourself,
Yeah.
and you're not really thinking about like, oh, what are the downside risks to this?
Yep.
And there's a theory out there of loss aversion, and this is something that I think is really big that people don't pay attention to. Is how do you feel when you actually lose money?
Yep.
So what this happens, that's so much of a more powerful emotion than making money. Because if you think about the times that you've made $1,000 and the times that you've lost $1,000, it's the same amount of money. It's just going in one direction or another.
Yep.
But that feeling that you have when you lose that money is so much more powerful, and it'll stick to you more, and it'll actually you'll start to make some really rash decisions, and you'll panic. Like your fight or flight hormone starts kicking in, that cortisol kicks in, and you're like, oh my god, no, I can't lose my money. And that's why bear markets and fall so much quicker, is because this loss aversion is just a cascading effect, and that panic starts kicking in because people don't like to lose what they already have.
Absolutely.
And
Man. Absolutely.
yeah.
I like to categorize exactly what you're saying as two separate things. Like one is like the certainty of something happening, and then the other thing is like the possibility. So like in the certainty part of it, you're like, okay, what is the probability of me winning winning $10,000 or winning $5,000? And then the other, you're saying, what is the probability of me losing $10,000 or $5,000? And in one, when you're thinking about the winnings, you're thinking about the gains. That gives you a fear of like a disappointment, because humans are constructed with ego, and so you're more fearful of losing money than you are gaining. And so
Exactly.
when you think about the loss, you're like, okay, I hope that I'm not going to lose. But then when you're thinking of winning, you're actually disappointed, because you're disappointed that you didn't win more. And this is what really gets people, because in one way you're risk averse, and the other you're like, okay, I want to take the risk on,
Yeah,
and then you
exactly.
have like one way you're hopeful for a large win of some kind, and then the other way you're like, oh man, I don't want to make this loss. So the ego plays with you, and because it is so much more difficult to manage your ego and the emotions, people get trapped into this like nobody's business. It's exactly what you said. $5,000 win, even though it's the same as a $5,000 loss, but in the other way, they have such a different way that it's looked at by our mentality.
Oh yeah. And the funny part is that it's really easy to get caught up in the emotion and go on tilt in either direction.
Yep.
And I'll give you a prime example is this melt up that we've been having, this V-shaped recovery that we've had since we've hit the bottom.
Uh-huh.
People see that, oh man, this person's making money hand over fist, or they just had this huge gain here. And you start to get that fear of missing out. That is a very powerful emotion too, even when it's going up, because you're like, oh, that causes you to chase. And that in itself is also just a recipe for disaster, because you start going off of, like you said, you start taking on more risk. You start walking away from the fundamentals that you've created for yourself for the risk mitigation, and you chase. And what happens? What happens when you chase? You're caught up in the moment. You know, you see this bull market, it's carrying you. You're getting super excited. You're thinking about these wins that you could get. Not that they're there, the ones that you could get.
Absolutely.
And then you just jump in full bore. You're like, oh man, I got to do this.
Yeah.
And then what happens? As soon as it turns against you, now the panic is even more intense.
Yep.
And that's why it's so important to, when you've got to create a plan for yourself. You've got to create rules for yourself, and you've got to stick to them. And if you look at successful traders, even in our group, like yourself, Kevin, me, we all have a method, and we all have rules, and we all have a certain way that we do things, because we know that we can't predict the market. I mean, we can use all the tools and charts and everything necessary, but the market is its own being, and it's going to do what it's going to do. Yep. And the most important thing that you need to do as a trader is control these emotions, control these spirits that drive you. You know, your bull spirit kicking into the point where you're just forgetting about all your risk management and everything like that, and then getting caught up in that moment. And because when that bear comes a knocking, it's going down fast, and that's why you see drops. Yeah. I think how did you describe? You did a great way of describing.
This is actually something that Jim says.
Bears.
Yeah, it's something that Jim says. He says that when bears climb, they climb like the staircase, and when I got it the other way around. When bulls get into the market, they climb a staircase, and when bears come to the market, they take the elevator down. But there's one other thing that I like to compare this exactly what you just said to. It's gonna be really funny, so bear with me. I like to look at these kinds of sentiments as like you're trying to court a woman. Say you went to a bar, right? And you're standing by the bar, and you see from far a really beautiful woman, and you're interested to court her, and you're like, yeah, you know what? There's two types of people. There's one type of person who goes straight up to her without a plan, right? He's usually the guy that's not thinking about anything, and he's probably the guy that probably doesn't use protection either, right? He's risky. he doesn't give a shit. He's gonna take everything that's possible just to get the woman, right? So he's gonna be like, okay, I'm gonna go balls deep and try and get this lady because I am so interested in her. And it's that moment, right? Emotions take over. You see, it's the same thing. It's exactly the same way your brain works, right? It's like, all right, I'm gonna go and try and court her right away. Like, hey, how are you doing, honey? And like, can I have your phone number and this and that, right? And that is the main essence of a person who doesn't take a calculated approach, right? Then you have another guy who's maybe a bit more experienced, has been through this scenario multiple times, and he understands that there's a way that you have to court a woman, right? You have to go in there and be like, hey, how are you doing? Can I buy you a drink? Be a bit more gentlemanly. You have a system. You have, a certain thing that you do. You have a nuance about it. You are not putting yourself 100% at risk. And most importantly, you use protection, right? So in one scenario, you're building a relationship, and the other scenario, you're looking for a one-night stand. Now, which of these scenarios would cause you a tougher situation? Well, guy A, who went into this without protection, has a higher chance of contracting some kind of a problem. And when the reality sets in, he's going to have a panic attack, right? And in scenario B, the guy who's more experienced and took time to think about the situation and use protection, well, guess what? He's not as panicky because he knew that he laid down the rules and had certain morals to deal with that situation prior to getting into it. So for people who can't look at it from the market sentiment, I thought I'll use a little bit of a layman term kind of a way to explain this.
Yeah, I think that what's interesting about that is a lot of times, and this is very akin to trading too, but even when you go and approach a woman, or even when you approach a trade, the way you're thinking about it, a lot of times people, they already draw out the outcome in their head. And this outcome is the favorable outcome. Yep. So if a lot of times the biggest difference is the people who, kind of have a methodology behind anything that they do in life, whether that's, going and talking to somebody at a bar or trading or anything that they do, is they think about the what ifs. They think about every single scenario. They don't just construct, all right, and that's why it's easy to get blind a lot of times when you just, you think about the profit, in trading versus like, hey, I'm going to trade and I want to make $10,000. Well,
Yep.
You're so far ahead because you already in your head think that you have this $10,000, or think that this woman's going to be, fall head over heels for you, So when that doesn't happen, it's, if you don't already have these scenarios played out in your head, or, all right, if this happens, what are my next steps, or what am I going to do to counteract that? A lot of times it's just not going to go well.
Absolutely.
So,
Sorry, I was going to say this exactly parlays into the endowment effect. It's exactly when, like, when you're in a trade, you have this cognitive bias where you're like, yeah, I'm in Apple long, so Apple's going to go up. Like, you have bias within your head because you construct that there because you're so fixated on making the gain that you're like, yeah, you know what? And then you start preaching it to everybody around you too. Like you can see this happen on the OptionsSwing chat every day in, day out. Believe me, people are constantly putting their ideas out there, which is good and it's fine. But some people, they have this bias, and then they kind of exuberate in such a way that they want everybody to realize that this is the trade, but they don't realize that it's a endowment effect. It's literally a cognitive bias in their head because they are so adamant on the fact that they want to make money from this situation that they start preaching it to other people without knowing that they're doing it.
Yeah, exactly. And, that's why you got to be really careful. I mean, nobody's going to be right 100% of the time. I think that every single person, that's within this chat, or just anybody who trades, is going to tell you, they're going to make a lot of wrong decisions in their trading. It's what you do when you make the wrong decision that is the factor between a novice trader and a great trader. Because if you're just doubling down without thinking about the, what if this could go the other way, or how can I minimize my risk, or you're just kind of, you're down 80-90% on a position, and you're just, you know what, I'm gonna hold out and just, I think I said this last time, hope and pray it goes my way. I mean, these sorts of things are, it's like it's these emotions that people don't think about, that you really have to master your emotions to be successful.
Absolutely.
And it's taken me a long time to learn that. It's not something that you can enter the trading world and you instantly get. You're going to lose money. You need to realize that. You need to accept that. You need to know how it feels to lose money. You really have to go through the process of losing some money to go to the next level. Like, you look at a lot of people. I mean, there's some extreme examples, but a lot of successful people have gone bankrupt multiple times before they've gotten to where they're at, or they've just made a lot of mistakes along the way. And they've learned from that.
That's me, man. I must have blown up my account 5 times before I learned. I'm telling you, like, I've lost easily $25,000 before, I learned this dear mistakes. And then, you learn from it. And that's exactly what the basis of the Everyday Growth Advisors came from, right? I made all these mistakes and I said, well, now I've come out of this much wiser, and I would hate to see somebody go through this. That's the reason why this channel was born, right? It was to help other people achieve this success sooner, so that they can learn from my mistakes, and they don't need to spend $25,000 to do it. But then, realistically speaking, like what you said, you have, even if somebody's going to be there to hold your hand, you have to make a couple of mistakes to learn.
Because it's an emotional game, and so everything we've just been talking about, like, it's just recognizing, because the stock market overall, what is it really when you think about it? It's kind of the emotional gauge of rich people more than anything else. So it's kind of like, okay, well, if you can understand, the emotions behind, not only your trading, but other people's trading, the market in general, you can learn to master those emotions. You don't get caught up in the FOMO. You don't panic, and make, go on tilt and make stupid moves. That's going to set you apart. And people think it's solely, hey, if I get better technical analysis, or hey, if I get, look, you can be a master of technical analysis, and there is going to be some hedge fund that's just paid millions and millions of dollars for a computer program that reads these charts a billion times faster than you can, and make a decision a billion times faster than you can.
Against you too.
Yeah, exactly. I mean, the odds are stacked against you. So you need to kind of realize, like, all right, well, what are the weaknesses? What are my own weaknesses that get in my way?
Yeah.
And you need to just kind of like, all right, I'm going to blast through these, and then go ahead, make a plan, set your rules, adapt to the market, adapt your strategy, to different market conditions, and you'll be successful. And go in for the long game. Don't go in for the Wall Street bets YOLO
Absolutely.
game.
I really need to address something here, because you hit something that is so close to my heart that I have to say it. So many traders come into the community of trading right now thinking that exactly what you said. Technical analysis is the first thing that I need to learn, and if I know how to read a chart, I'm going to be able to make money. I'm here to tell everybody who's listening to this podcast that whoever who has told you that you need to learn technical analysis first is a complete idiot. And I mean to say this in the most respectful manner, but to let you down easy, to deflate your ego and explain it to you in a very simple manner, that if you think that support and resistance lines are going to make you money in the long run, you are gravely mistaken, because that is literally the basis on how a market maker makes money. Okay. And for people that don't know what a market maker is, it could be a person who's your broker. It could be a person who's processing trade orders. These are people that are filling in gaps within bid and ask prices, which are the prices that people want to buy and people want to sell, and they create liquidity for the system. Okay, that is the definition of a market maker. Now, if you want to understand why support and resistance lines don't make you money, it's as simple as understanding this. If you submit a order for a support or a resistance level at which you are expecting a stock to turn around, and that level happens to be the same level that thousands of other traders are anticipating a reversal at, guess who has access to that information? It's the market maker. So he knows exactly where you have your limit order set up, and he can take a trade that is going to be going against you. Hence, the market makers can take positions that push you out of those limit orders that you have and cause you to squeeze out of your positions. And this is the main essence of why technical analysis is not a sure shot way of making money. You have to understand where risk is flowing, where the sector rotations are, and where capital is being put into. That is the basis of how the stock market moves. It's just like how Mike just said, you need to understand how the rich are moving their money over it. Where are they moving it to? And then you can start to understand the bigger picture. Technical analysis should be just used as like a entry and exit understanding. Like, okay, this is where I will roughly enter, and this is where I will roughly exit. And you don't use them as a sure shot price, like I'm going to enter at 127 or I'm going to exit at 128. You create a zone, because a market maker can't track your zone, but they can track your price. And I rest my case.
Yeah, I think it's important to kind of just not rely on just one thing. You know what I mean? And that's always kind of the worry that people have, especially coming in. They're just like, hey, like this person or this method, it's the end all be all. I'm just going to follow that blindly. No, you have to do your due diligence. You have to really understand even what you're trading. I mean, the funny part is that a lot of people trade options. They don't even, like we talked about, they don't even really know like what an option is.
Absolutely.
A lot of people look at it as just like, oh, this is where I place my bet. But the option contract, there's an underlying asset in there, and that underlying asset is shares of stock. And who owns most of the stock? It's going to be institutions. So when you buy a call option, it's an institution that owns 100 shares of the underlying stock that is selling you a contract. And
Yep.
if 99% of the people are buying calls because they're so sure that this is going up, well, the institution owns all this 99% of the shares, just sold these contracts. You think they're going to want to let go of their shares or
Yeah.
lose money that easily? No, they hold the power. So that's why it's you can't rely just on one thing and just think that I could beat the market if I just know this one thing. No, it's going to be a combination of a lot of these factors.
Yep.
And as I said, just realize you're going to make mistakes along the way, learn from your mistakes, control the emotions, and stick to your plan.
Absolutely. That's a really great way to wrap up the trading psychology part of this podcast. And dude, man, so many gems being dropped on this podcast. I really, man, I enjoy speaking to you, man. I can't tell you how much from the bottom of my heart I want to thank you for coming on this podcast with me, because I finally feel like I've connected with somebody thousands of miles away that finally understands how I feel and is able to converse with me on a much deeper level about these subjects. And the beauty of it is people are listening in right now from wherever they are in the world and learning so much just about from us having this conversation. And that, I feel, in its own right, is such a beautiful thing. So thank you.
Yeah, absolutely. It's all about I'm all about the educational part. I love this. I fully support the educational part. I think the conversations that we have are fantastic, and we feed off each other very well. And we are deep thinkers in the market, and we've been in the market for some time, and that really helps. So our experiences and the knowledge and the mistakes that we've made, we can kind of showcase that for you, so that you can learn from other people's mistakes and experiences.
Absolutely. So the next part about the next segment of this podcast was actually us diving into a couple of ideas about tax obligations. And you brought up a
Yeah.
very, very good point that many people overlook this. And I've seen a couple of people asking about these, but people don't even realize what are the tax implications of capital gains, and how do you go about managing those. And I really like the things that you were telling me earlier. So take it away, man. I know that you have quite a few things to talk about the subject, so take your time. If you need to take a breather, please do that too.
Yeah, the funny part is that the reason I even brought this subject up is because I think a lot of people, this is the first time they're actually getting, some people are getting large sums of money, almost like a lottery,
Yeah.
and it's kind of like that lottery effect a little bit, where, how are you going to handle yourself when you have a windfall of money? Well,
Right.
The mistake that people make is they don't think about the gains that you're making. Somebody else is definitely getting their piece of that. And I just had a recent example the other day, because one of my best friends, he already has a pretty good income from his job. So, he's already in a particular tax bracket, but he was talking about like, oh man, I'm really excited about these gains I got. I just, made, I'm up 100K on this position here. And,
Oh boy.
I'm going to, I'm going to sell and I'm going to, I don't know, maybe I'll go buy another boat or something like this. And I'm like, I said, well, that you're going to pay 37% on that 100K that you just got, right? And he's like, huh? I thought it was 15%. And then it got me. Yeah, it got me to realize, like, oh wow, this is an important point that I think people. This is a quick tidbit of information, but this is going to be important for a lot of people. Capital gains only applies to positions that you hold for more than a year.
Yep.
Period. The end. So if you have bought and sold a stock, an option, anything like that, and you have a gain and you have not held that stock or option, it actually is added to your income. So if you really need to look at, okay, how much do I make as a base, like through my job or anything like that? And then if I made an extra $50,000 on top of that from trading options, where does that put me in the tax brackets, which is easy to find on online on the IRS website? And then what is the tax rate on that? Because it's going to be a shocker for a lot of people that, oh wow, an extra 15 to 20% of your gains are, on top of what you thought you were going to pay, you're going to be paying. So it's not free money.
No,
And this
not.
is interesting. The most interesting thing that I find about this is that, a lot of people are just like, man, Warren Buffett, he doesn't know what he's doing. And, you and I were laughing about that because it's like, yeah, but there's a lot of things that Warren Buffett's doing that people don't know that are extremely smart. And one of the things that he does is he does not buy and sell assets quickly. He holds on to them for over a year. Why is that? Because that could mean an instant extra 20% gain just on tax savings.
Absolutely.
So So I think that's really interesting. I think that if people aren't really familiar with how the taxes work, or if they're making a huge gain and they've never got that before, just know that take a part of that money out and set it aside. Because the worst thing that can happen to you is you make a ton of gains. Say by the end of the year, you're up $100,000. Then first part of next year, that $100,000, it's like, oh man, I just lost all of it. Well, guess what? You still need to pay taxes on that $100,000 that you made by the December 31st. So you need to come up with a check for that. And if you can't, you're going to be in big trouble. So that's the important part that people need to think about. When you're getting these gains, don't go and spend all that money.
Absolutely. Another thing about taxes that people don't realize, and I know this is a common misconception. People don't even understand how taxes work to begin with. So let's say you fall within a certain tax bracket, and I'm just gonna say this for the benefit of people that don't know much about taxes, or you're trying to understand how this works. Let's say you add your capital gains to your taxable income. Well, let's say you made $150,000 that year. It doesn't mean you're going to pay a flat rate at the tax of $150,000.
Right.
It's broken out into brackets. So the first 10% will be taxed at a certain level. The next 10% will be taxed at a certain level. The next 5% will be taxed at a certain level. So it's broken out into a bracket. It's not like you're paying a flat rate across entirety. Your tax is always kind of based on how much you make in total, and then they chunk it into these brackets, and you pay
exactly
aggregate of all of those tax levels. So just to put it out there for people who don't know how it works, that's kind of how it works. And just to summarize the tax obligations that we were discussing. To end off this podcast, I want to tap on a very important thing that summarizes everything that we've discussed so far. And that is the stock Nikola, right? Which is a hotly debated stock in every chat room probably right now.
Oh yeah.
And it hits all of the notes that we've been talking about this entire podcast. The irrational exuberance, people buying in when IVs are at 500%, people thinking that this is a stock that's going to go up forever, and then boom, it goes up, and then boom, it bursts like a bubble. Exactly like it's the accelerated version of the dot-com bubble in 1 week.
Yeah, exactly. And myself too, I've actually been posting a lot of my trades that I've been doing on this. And one of the things that the reason I've been trading this a particular way is you hit the nail on the head. When you can identify certain bubble stocks, you can still play them in a much, much, much safer way. So, the great thing about what happened with after VTIQ became Nikola and got that symbol is that, so much of the hype and FOMO came in, and it's just, you look at it fundamentally. I mean, right now, this company is in the very, very beginning stages They don't have any products made yet. They
Yep.
won't even have anything for a couple of years. You know, they've just secured funding to kind of start the process.
Yep.
You know, so when this company just all of a sudden, you know, just on hype and fear of missing out becomes worth more than an established vehicle manufacturer like Ford, you know, that's the time to kind of take a look at like, okay, this has gotten out of the fundamental realm of reality.
Yep.
Because that's really what happened when I first started looking at this. You know, I watched the stock go up because I played a wheel on it earlier with VTIQ because the premiums were high. But if you ever see this happen, this is again a time that you can adjust your strategy or take advantage of certain market conditions or certain even, you know, stocks that may have like a weakness in them. And the weakness in this one is that everybody was just paying top dollar for the stock and the options.
They didn't care.
IV, yeah, they didn't care. They're like, hey, man, yeah, this thing's going to 200, even though it already went up 500%,
Yeah.
or you know, a couple 100%. Yeah, it's just going to go up another 1,000%. It's like, again, that's a very irrational way of thinking.
Yeah.
And you know, but how do you exploit that? So as a rational investor, how do you exploit things like this? And it's very simple. You know, if you see an example like this, you can take a look at the premiums. This is a perfect candidate to sell premiums. So what I did is I'm looking at this like, man, you know, hey, this looks like a pump and dump scheme to me, more than anything else. But what's great about that is that I can sell a put that's way under the current stock price right now.
Uh-huh.
I can get in an absurd amount of money. I think I sold a 45. I know at one point I sold a 50 put for almost $1,100. Yeah, and think about that. So now
Wow.
my break even on the stock is now under 40 a share.
That
So
is
really,
crazy.
yeah. So really now it's kind of like, okay, the stock just went, at this time it was it shot up to the 80s or almost 90. And now I'm getting paid to wait for the stock to drop to 30 some dollars a share. And
Yeah.
I mean, that's just a win-win. So, you know, and then it dropped down. Guess what I did? I doubled down. I sold a 45 put for $1,500.
Oh
Think
my
about that.
goodness.
I got $1,500 cash, no matter what. Like I get that
Jesus.
premium, it's mine. Now it's just a waiting game for me. I'm letting theta burn. You know, that IV, it's gonna crush.
Yep.
As soon as there's any stabilization whatsoever, or it kind of like finds its price direction, there's gonna be an IV crush. And that put that I got paid $1,500 for, I'm going to be able to buy back for about $100. So that's $1,400 profit from that.
Yep.
You know, and what's my worst case scenario now? My worst case scenario, this thing keeps tanking. Well, you know, my buy-in between those two options, when I subtract out the premium that I already got,
It's a very low cost.
yeah, it's going to be in the low 30s.
Yep.
So, you know, this thing can continually go down and I'm still going to be okay. The problem comes into when I want to pay top dollar for a call or even a put. You know, I've got to pay a lot to play that game and just hope it goes in that direction. Because at the end of the day, when you buy a put or you buy a call, you've got one profit scenario, and that is it goes in your direction and it goes enough in that direction to cover the cost of the premium.
Yep.
That's a one directional profit play. When you sell the premium, that stock can go up, you're making money. A stock can go sideways, you're making money. A stock can even go down quite a bit. You're still probably making money because of you know, you've got a good gap. So I like, you know, when these scenarios happen, when the IV explodes, because I can get an option so far away from the current price that there's my risk mitigation. So I'm getting money regardless. And my risk is very low. I'm taking the least risky position I can if I'm going to take a position in this, because buying the stock is risky. It's flying all over the place. Buying a call or put is risky because the premiums are so high. But if I sell a put and the strike price is way below the current price, that's a great risk mitigation strategy, and this is a perfect candidate for that. But again, that's me exploiting this irrational exuberance that we're seeing right now.
Yep.
And so you're going to be able to see a lot of candidates like this, especially now that we're seeing people dumping money into the companies that are going bankrupt, and these stocks are flying. Oh man, CHK, Chesapeake was one that I saw. I mean, you got to look at that chart over the last week.
Hertz as well. Hertz was another.
Yeah,
one.
Hertz as well. Yeah, that one is ridiculous. Yeah. So it's like, okay, cool. Now we're in this environment where, things are flying for no reason and everything. Capitalize on it by, keeping a rational mind, keeping your emotions in check and making the smart play. Make the smart play. Don't chase, because that's when you're going to be left when the rug gets pulled.
Yep, I agree. And there's another, for people who are listening to the podcast, and I know that there are some people on the beginner level. So let me try to kind of explain a very basic concept about what Mike is talking here. When you are in a market that has a lot of action, volatility, right? People are constantly buying and selling things. Well, what that does is that because there are so many people who are betting on either side, it causes everything to be more expensive. And that happens when the implied volatility of an option spikes. And so when the implied volatility of an option spikes, what happens is that on both the put and the call side, things start to get more expensive. And so Mike, very smartly, he played this in such a way that he risked the least to get the most out of this. But one important thing that you need to note, and if you look at Nicola's chart, you can see if you were to look at this from an institutional side, right? Think about how an institutional would have played this, right? Well, they would have got in before everybody, right? Let's say somebody bought a shit ton of Nicola shares and is sitting on them. Well, it's just like what Mike said earlier, and this should be something that you should learn. Okay, if they got in at a pretty low price, for example, around $20 to $30, and they have all of these shares, well, what do you think they would have done? They would have sold calls against these shares, right? And if they knew that the price was going to spike up and go to an unbelievable level, well, guess what? All those call shares, they are not going to allow them to be called away. They're simply going to sell those shares. And since the price of those contracts are going to be determined based on those shares, they will get to collect both the bags. And you can see that's exactly what happens. It looks like institutions sold calls at around $100 and just sold all their shares very quickly to bag those gains. So both sides, they got paid.
Just banked. Yep.
They got paid both sides. They got the money from holding those shares and then sold those shares right at the top while selling calls above it. And it was a beautiful scenario and a beautiful payday for both of those scenarios, right? So, those are the things you need to understand. The option contract is dependent on the underlying asset. And if you make the mistake to believe that the option contract is going to keep going up and up and up and up, you're mistaken, because the person holding the shares has the power. They can put it down. And
that is such a key point. I know we've mentioned a couple times, but that is the thing you need to keep in your mind, is that all these option contracts are, based on an underlying asset, and whoever controls that underlying asset has the control.
Yep. And so if you jump into the scenario and you behave like the retail trader trying to make money from going long those options, the chances of you failing is very high, because you don't have theta working for you. You have theta working against you. So the longer the time goes on, you're in a very disadvantaged situation. This is the reason why I didn't play Nicola. And I knew that this would be just, something which goes up and then comes down very quickly. Now, it doesn't mean that Nicola can't go up again. All I'm saying is that I'm willing to bet top money that somebody got, like a whole bunch of people got caught holding the bag, and they've lost thousands and thousands and millions of dollars at this point, right? And so, that's precisely how people get into these sticky situations and end up losing money. Because I was in the chat when Nicola was at $90, and people were still asking me, should I get into calls now? And there were people who were like, yeah, it's definitely going up. It's going up to $120. Look, there are 120 calls being bought. And I'm like, yeah, guys, I don't think so. I'm sorry. This has to come down before even it makes a new move up. Because as Mike says, the pendulum swings one way and then comes back the other way before centralizing in the middle. So,
Yep.
with that being said, I want to end this podcast here. I know that we're eating up a lot of time, and I really, really appreciate you, Mike, being here today. I look forward to many more of these. I feel like our listeners would have gained a treasure trove of knowledge with you being here today. And I, so very much so appreciate you. I can't wait for the next one and the more topics that we're going to cover, man.
Absolutely, man. Thanks for having me on again. Yeah, I really like that. We see eye to eye on a lot of things in the market, and that just opens up a lot of possibilities for topics that we can discuss and take a deep dive on.
Absolutely. I can't wait for the next one. We will probably, make this, hopefully, if possible, we'll make it a weekly thing, where we can just jump in and talk about market conditions and give people an update. That will be a beautiful thing as well. So,
Cool, buddy.
I'm going to let you get some sleep. I know it's kind of late over there. Thank you so much for taking this call with me, and I will see you on the next one, Mike.
Sounds great. Thanks, buddy.
All
We'll
right.
see you.